Let's get some insights in the news shaping the markets. For that, we welcome in Rebecca Walser is here, President, Walser Wealth Management. Thank you for being here.
Love to be with you, Nicole.
When you're here in person. So tell us a little bit about, obviously you mentioned the whipsaw comment, so I gave you credit for that. It was really a wild ride yesterday.
Yeah.
What do you attribute this big sell-off we saw the prior week, the whipsaw type of volatility we're seeing?
Yeah, you know, this volatility is really the intraday whipsaw yesterday, the largest since 2022, Nicole. So that is a little bit of a tell. Volatility VIX was up to the 21 at the beginning of the week. We saw oil drop 3% on Tuesday. So what we're seeing is a massive signal flashing that global demand is dropping, which means that we're seeing a lot of recessionary pressures. We know that China has got massive issues. We know that Germany's manufacturing is depression level, Nicole. A lot of energy problems in Germany, obviously with the Nord Stream and all of those things. So they're restarting nuclear power, all of these things. But what is telling us is that all of these predictions that we're going to have this soft landing, that the Fed is going to cut and everything's going to be fine, is not really what's happening in the market, because the yields have already come down. We've disinverted on the 2 and 10. That is a tell that now we're potentially in recession. So we have big challenges ahead.
So are you really saying that we will dip into recession?
I think that we're already there, and that it just hasn't been officially declared because of our GDP, which has been supported by a lot of government stimulus, both fiscally and monetarily.
Yeah, so what needs to change?
Well, for one thing, the fiat-based system, as the Federal Reserve cuts, you know, the whole world is expecting us to cut, and we are, of course, the laggard. You know, we just saw ECB cut another 25 basis points this morning with Christian Lagarde. So we're the laggard. They're not leading. They are following. The yields have already dropped massively. Nicole, you've seen the 2-year in the last 6 months drop massively. And so this tells us that the Fed is really just reacting, and they're really already kind of fighting against the factors that they kept rates too high for too long.
Yeah, look, the 2-year, as you were noting, lowest since 2023. I mean, we're at the lows of the year, no doubt.
Absolutely.
So do you think that the Fed should bite the bullet and go with 50?
Well, I think that in order to continue to stimulate a fiat-based, debt-based system, that is what really would need to be required. But when you have sticky CPI that we saw yesterday on core, and you saw again PPI today, also harder than we expected, it's really hard to come in with the 50 when inflation is still an issue. So I don't see how they're going to continue to walk that fine balance and have this soft landing scenario continue to be in the news.
What did you think of earnings season? I mean, and you look at the forward earnings, there was a lot of concern about the consumer, no doubt, but what was your takeaway from earnings season?
Well, I think obviously we had a mixed bag, you know, and everybody that even if they had a double beat, they still gave us poor guidance, and so their stocks still suffered, right? And like, look at Apple, how are they going to monetize AI and things like this? But, you know, I like to go back to UPS in July as a really good leading indicator, saying that forward guidance was dropping and shipping is dropping in the U.S., which basically tells us the consumer is running out of steam and they're going to need more stimulus. And how are we going to have more stimulus when we just can't keep stimulating an economy this large with that much stimulus?
I would say a lot of people think the Fed will cut between 75 basis points and even a full percentage point between now and the end of the year.
I mean, yes, and that is a concern too, because, you know, we're so wide. Right now we're 5.2555. The ECB now is going to be 3.5 from the 3.75 that they were. So this is a huge gap that we have to rectify, Nicole. So yeah, I think the Fed is going to have to cut. But again, this sticky inflation, this tightrope, they've backed themselves into a corner. I don't know how they're going to manage this.
At this point, what do you tell investors? There may be some people who have cash on the sidelines who've been waiting to put that to work, or someone who owns the Mag 7. What do you tell some of these folks?
I think if their risk tolerance is such that they cannot handle a 30% retraction, they should go to something that's more safe. And I know, I see your face, 30%, why? But look, the Somme rule's been triggered. We've disinverted on the yield curve. We've had the longest inversion between the 2 and 10 ever in our history. So I'm seeing, based on economic indicators, a 30% stock pullback will come. The timing is always the question. And so for people that are on a shorter term and don't have as much risk tolerance, you need to go to more safety.
So yesterday, the S&P was looking at 5,400, right? What are you looking at really on the S&P? I mean, the low, 4,100 last November.
Yeah.
Where do you think we could be?
Because we are so hyperinflated on everything that's AI, but, you know, it's just been so kind of like irrational exuberance for Alan Greenspan back to the dot-com crisis, you know, that kind of time frame. I see at least a 30% pullback in the very short term.
Yeah. So what do? Do you buy some of your favorite names when we're down 10%, or you want to wait until you're 20% and that's a real correction?
Yeah, I mean, I would definitely wait until we get into correction territory before we buy the dip, because even though I love buying the dip, this is not a normal dip correction territory. This is something that's more systemic and is going to take longer to figure out, and it actually might be bigger than 30. So we just want to be more cautious. I hate to alarm you, but I'm telling you, this is what the economic indicators are indicating.
I understand what you're saying. So, I mean, Mark Faber came out. He called the 87 crash.
Yep.
Remember him, of the gloom and doom
Yes.
report. You know, he's saying much of the same, how the Mag 7 is gambling, and, you know, what do you tell them to buy then when you're 30% down? What do you buy?
Right now, our strategy is what we call bridge assets that we know do well in a transfer of either economic activity as far as systemic global finance, you know, happening and stimulating, keeping the prices up. So we would look at commodities, gold, silver, the bridge assets to get us from whatever we're in to where we're going. Those are going to do well. We expect gold to be 2,600 by the end of the year at least. It could be 3,000 depending on what happens between now and then.
Right.
So if you really want to protect value, you need to go to those commodities that will get you to protect value and not take the AI bet, which is a gamble right now. AI has a long runway, Nicole, but it is bumping up against this global crash.
Take profits on AI.
Take profits on AI before the pullback.
Anything else, financials and drugs and airlines. I mean, take profits.
I think that you should take profits because this is a systemic problem that we're facing. This is not specifically to any sector. This is systemic, and therefore, if you don't have the ability to take that much of a loss in this year, you should go to defensive sectors and just realize that the utilities and the consumer staples, which are defensive, also will come down because this is systemic.
I will say this is one of the biggest calls on Wall Street right now.
Yep.
So what brought you to this point, and how different is it from your call, let's say, a month ago? What changed?
Well, when you have the SOM rule triggered and all the economists are coming out and saying, even the author of the SOM rule saying it doesn't really apply anymore. When you say that the 2-year and 10-year inversion of the longest in the history of our country doesn't matter anymore, you've got people that are not living in reality and don't understand that eventually the chickens come home to roost and we will have to pay the bills. So I am a contrarian because everyone else thinks that everything AI is just going to bring us all up and it's just going to be global heyday, and that's just not where we are.
Could a change in the administration change things?
I think that, a Trump administration would be more favorable to the markets than a Harris administration. However, no administration is going to be able to fight back this global tide of macroeconomic changes that we are living through right now.
Rebecca Walser, thank you so much. Rebecca
you.
Walser of Walser Wealth Management. Thank you.